In this episode, you are going to learn what the strongest fair value gaps are and how you can use them in your trading. Now, diving straight into it, we see Fair Value Gaps Volume 3 and diving into Section 1. If we want to understand what the strongest fair value gaps are, then of course that starts with the understanding what are the weakest fair value gaps. Now, number one, the weakest fair value gap that we have is a mitigated gap. Then the second one is a manipulation gap. These are known as false fair value gaps, and these can create a formation that we see on the right, for example, right there. Now, what actually is a mitigated gap? That's the first step to understanding the strongest fair value gaps. Section 1, we see what is a mitigated gap. A mitigated gap starts with an old fair value gap. We need to understand all these gaps that we are talking about, of course, they are initially just fair value gaps, right? But those fair value gaps, we can label them and be a little bit more specific about them, so we can actually understand what type of gap it is, rather than just all being fair value gaps all over the place. So, mitigated gap, first step is understanding it's an old fair value gap. Then the second thing is that old fair value gap had a lack of a new fair value gap. Then the third thing, the third bullet point, is that we are then seeking liquidity. So if we take a look quickly at the left before we dive into the trading view chart, we see here that a fair value gap is being created. We trade back into that fair value gap sitting right there. After that, we do not create a new fair value gap. So the lack of that new fair value gap, that lack of that new fair value gap being created, that indicates to us that we want to target liquidity in the form of the bottom of that fair value gap usually has some type of swing low. That red line is exactly where we then want to target. So what does this look like in a chart? Here we are on Euro US dollar on the weekly time frame, and the first step that we had was understanding that old fair value gap. So what actually and when is a mitigated gap actually created? Well, this right there is a fair value gap initially, right? Then once we trade back into it on this candle sitting right there, that becomes a mitigated gap. So a mitigated gap is very simply said, a fair value gap that has been traded back into. Doesn't matter how big the sting or how big the move back into the fair value gap is, as long as it's traded back into that fair value gap, even with one singular pip, that is a mitigated gap right now. So that is important to understand, because once a gap, a fair value gap, has been traded back into and it turns into a mitigated gap, that is not a fair value gap that you can use again to trade off of. No. But what does it leave behind when we do trade back into a fair value gap and it becomes a mitigated gap? Well, that creates the formation of a swing high right there. So the only thing that you can trade off of, and the target, if you were targeting right there, for example, on this leg higher right there, the target could be this swing high, but not the fair value gap sitting right there. So the fair value gap as well, what I see quite often is that people drag it all the way to the right there, and they think, all right, well, look at how many rejections we have right there off of that fair value gap. Well, then I would argue the fact you might be a support and resistance trader, so that strategy might be better for you. And it's the same fact as if I were to draw a random line right there and I were to look all the way to the left and think, oh wow, we have some support and we have some resistance, we reject off it, we also respect it right there. It's the same exact logic. So that doesn't make sense in my eyes, and that is not how fair value gaps work. It's very important to understand. So if you were to target this, then you were to target this swing high. It's the same if you were to use this as a premium array to now continue lower off of, so where you want to look for your entry, for example, it becomes the swing high, not the fair value gap anymore. So that is what I mean when I refer to that old fair value gap on the bullet point, what is a mitigated gap. Now, the second one is the lack of a new fair value gap being created. And this is how we create tops and bottoms in the market. That is through mitigated gaps, as well through manipulation gaps. So this is one version of how we create a top and a bottom in the market, which is done through, if we follow the fair value gaps right here, then we simply see we constantly have a fair value gap and a new fair value gap is being created lower off of that. And eventually we arrive at this bottom right there. And we have this fair value gap. Now, in order for a new fair value gap to be created, the first candle right there, like we discussed in the previous episode, rejects. It rejects, and that already shows lower time frame fair value gaps, right? What we talked about. Then the next candle can continue lower. The next candle, if the first candle already rejects lower, is expected to make an expansion phase, to create an expansion phase of that fair value gap. What is the expansion phase again? An expansion phase of a fair value gap is the second candle. But for example, if we look at this first fair value gap right there, and this is number one, that's candle number one. Then we have candle number two, that's the expansion phase, because that creates the actual fair value gap right there. It's a large body. Then we have candle number three, which of course validates the fair value gap because it does not trade back into the low of candle number one right there. So here we see that we are not creating a new expansion phase. And then afterwards we are trading higher right there. This is known as the lack of a new fair value gap. So the non-creation of a new fair value gap also tells us a lot about where price is actually heading towards. Because if we were to create a new fair value gap lower right there, then we could have easily taken a new trade off of that and we just easily continue lower. Where that does not happen. So what happens? Well, what is the third bullet point that we had in the mitigated gap PowerPoint? That was liquidity. So the lack of that new fair value gap right there, the new fair value gap that doesn't get created, that now indicates that we have tried or we have offered fair value right there. And when we have offered fair value and we are coming back into this fair value area, then we are clearly not again offering fair value because fair value right there only gets offered once, can't get offered twice. So instead of fair value, how the market moves again, how does the market move? It's either offering fair value or it's seeking liquidity. All right, so we're not offering fair value anymore. So what are we doing? We are seeking liquidity. Remember the old fair value gap that we talked about right there, where once we trade back into it, now the target is not the fair value gap anymore at this right side. No, now the target becomes the swing high right there because we've already offered fair value. So now we are seeking liquidity instead if we're coming into it a second time. It's the same situation where this first candle right there trades back into it. We do not create a new fair value gap lower off of that, which is mainly seen by that second candle, which can also sometimes be the third candle. And the reason for that is because, for example, this one right there, this fair value gap, we still sweep the previous previous week high right there before we continue lower. And that can still happen, right? What we discussed in previous videos and previous episodes as well. Now, then that third candle creates the expansion phase. Right here, the first candle is already a big rejection. Second candle should create the expansion phase. Does not happen. So this fair value gap is a mitigated gap. So if we trade back higher right there, we do not target this fair value gap, we target the liquidity, which is the swing high being created right there. So I need you to understand, because this is a major game changer, as I like to call it. A lot of people think when you trade fair value gaps, you only trade it in the usual manner where you have just a fair value gap and you're expecting higher price off of that. Well, the fair value gaps are so beautiful because if we do not continue higher or lower off of that fair value gap, then clearly we are doing the opposite. So when we do not create a new fair value gap of the previous fair value gap, then likely we are doing the opposite. So likely we are going the opposite way. That allows us to then go into the lower time frame right there to look for our usual fair value gap again to find a trade into that liquidity right there, into that swing high. So in this weekly scenario right here, if we want to target this swing high, let's actually look at that daily time frame, what that looks like and what I meant with then that usual fair value gap to target that swing high again. So diving into the daily time frame, then we see this was the weekly fair value gap right there. And of course, yes, we see a daily fair value gap right there after coming into the weekly fair value gap. But a lack of new fair value gap is always seen from the same time frame perspective. And what I mean by that, if it's a weekly fair value gap and we look at the lack of a new fair value gap, then it should be the lack of a new weekly fair value gap of the previous weekly fair value gap. That's very important because otherwise, of course, of a weekly fair value gap, yes, of course, you're going to have 1 minute fair value gaps, but that's not relevant. So what are we actually seeing here? Well, before we actually do not create that new weekly fair value gap lower, we see on the daily time frame, we have this daily fair value gap and the same exact thing happens. First candle already rejects when we come into it. Second candle should be an expansion phase, does not do it. What becomes the target? First target sitting right there. Why is that? That's that liquidity again. Lack of new fair value gap, mitigated gap, target that liquidity, that swing high being created in that fair value gap. Where afterwards we come into this fair value gap as well, but we already know at that moment in time, we have not created a new weekly fair value gap lower. So then once we create this daily fair value gap higher right there, what does that become? That becomes a very nice fair value gap to eventually trade off of. But before we actually go over that, we need to dive into manipulation gaps as well. So we have a basic understanding of the mitigated gap. Now from section 2, let's move on to section 3 and let's dive into the manipulation gap. So what actually is a manipulation gap? It is, and it happens at a reversal area. That is exactly when you can expect manipulation gaps to form. Now, manipulation gaps are seen through disrespect. When we disrespect the first fair value gap and a new fair value gap is being created, that is exactly disrespect, what we mean with it. Then the third bullet point that we have is a sharp turn, an ST. And whenever I refer to an ST in a video, I refer to this, I refer to a sharp turn. The picture you are seeing on the left side of your screen right there, that is exactly a manipulation gap. And that is exactly a sharp turn. The overall picture and the overall scenario is a sharp turn. It creates a sharp turn in the market. Now, what are we seeing right there? The red line is the reversal area. So that can be a premium array, right? Where you are expecting lower prices. You do not necessarily need to expect lower prices, but it's just a premium array where you know there can be a rejection, can potentially be a reversal. We'll see what happens. Now, how can we know that a reversal is actually happening then? This bullish fair value gap that we are having right there, that is known as a manipulation gap. At that moment in time, it's just simply a fair value gap, right? Coming into a premium array, into a potential reversal area. The two down candles that we have right there, they are not there yet. So in first instance, the three bullish candles is just a fair value gap. Afterwards, what do we see? We see a first down candle trade back into the fair value gap right there. No rejection, no signs of rejecting, closing inside the fair value gap right there as well. All right, we know the only area that we can now continue higher off of is that previous candle low right there. If we sweep that, which we do not do, we continue lower and we fully disrespect the bullish fair value gap, and we are in the midst of creating a bearish fair value gap right there. That overall scenario then creates a sharp turn. The first bullish fair value gap then becomes a manipulation gap. So when we talk about this is potentially a manipulation gap, this is exactly what we are referring to, and this is a scenario that might play out. So what does it look like in the chart? They're moving from these mitigated gaps and now incorporating manipulation gaps. If we go over the weekly time frame again, then on the weekly time frame, we are seeing a few examples of manipulation gaps, where a great example is this one right there. We had that swing high. That was, first of all, our draw on liquidity right there. After we reached that draw on liquidity with a lot of bullish momentum, and again, that is what we went over, right? Bullish momentum and in general, fair value gaps showing that there's momentum in the market that can also be used against us. But now we are becoming aware of it, that fair value gaps, they are not simply, all right, bullish fair value gap, bullish momentum, price is always going to continue higher. No, because what happens afterwards, we have this large down candle into that bullish fair value gap. This is a clear sign of disrespect. With disrespect, I mean the exact opposite of what we went over in the previous episode. Where again, respect, for example, when we sweep that previous week high, we are respecting that because we are wicking it. And when we are closing inside of PD raise, for example, we are simply closing very heavily inside that fair value gap, that indicates that we are disrespecting it. With as well, this is of course overall a fair value area like we talked about. So we are expecting higher prices right there, which eventually we do not seem to get, which then after the disrespect and the new bearish fair value gap is created right there, creates a sharp turn. So the whole area right there, and it's actually perfect because it's perfectly 6 candles where we have bullish fair value gap, bearish fair value gap, that creates then your sharp turn. Now this sharp turn is of course where we now have a bearish fair value gap sitting right there, where the bullish fair value gap is a manipulation gap. The bearish fair value gap that disrespects the manipulation gap, so that disrespects the bullish fair value gap, is now a strong fair value gap and is exactly what you are looking to trade off of. Where eventually when we do come into that weekly fair value gap, the bearish fair value gap, and we go into the 4 hour, and that's still the higher time frame, right? Then we see the exact same thing happening. We have our reversal area, our potential reversal area right there. After that reversal area, we have a bullish fair value gap coming into that reversal area. After, we see the same exact thing actually that we had on the example in the PowerPoint, where we come into that with the first candle. Second candle just explodes lower again, creating a disrespect, creating this manipulation gap. Well, just equally as important, of course, is that we are creating a sharp turn, which leaves behind this bearish fair value gap sitting right there. And that is exactly what we want to see. So to break this down in relation to the previous video and in the steps where we were, because we were talking about the bias in the main first few videos. Now we are looking at bias a little bit more as well, but we're slowly starting to incorporate narrative. Again, let's define bias together again. Bias is the direction, it's the draw on liquidity, right? So if we look at the weekly right there, then that bearish fair value gap that we have, that indicates to us, all right, we might actually be bearish right there. With overall the draw on liquidity being this low, that first swing low. That is now the draw on liquidity. The narrative becomes, how are we going to deliver into that draw on liquidity? So a very simple question to ask yourself, which sets off a chain reaction of thoughts in your mind, which is exactly why you need to use questions in your trading plan, which is, if we are going lower, where are we going lower from? Which simply refers to, what is a premium rate that we can head lower from? Which the only premium rate that we have right there is this weekly fair value gap. And the same question goes, of course, if we look at the other scenario that we had right there. We see this mitigated gap, we target this liquidity. All right, on the weekly, we do not necessarily have a clear discount rate. We do not have a fair value gap that we can trade higher off of nicely. So when we then went into the daily time frame, we have the same thing where we had a previous week low to the left. We had a bearish fair value gap coming into that, a bullish fair value gap sitting right there with the mitigated gap, all signs that we want to continue higher right there. So at this moment in time, if we just ask ourselves the question, well, if we are going higher, where are we likely going higher from? We have this fair value gap, and we of course have the order block sitting right there as well. Which order blocks and the strongest order blocks is exactly what we are going to go over in next videos as well. All right, so we have a great understanding of the mitigated gap and the manipulation gap. Those gaps are the weakest kind of fair value gaps out there. So when we understand the weakest fair value gaps, then that allows us right now to go over section 4, where we go over the strongest fair value gaps. The first thing we need to understand with understanding the strongest fair value gaps is the relativity theory. The second thing we need to understand is the bias. The third thing is two fair value gaps. Now, what do I actually mean with these different points? The relativity theory, meaning that every fair value gap should be in context of the fair value gaps above it. Then the second bullet point was bias, and bias, it's very important to understand the draw on liquidity. So the direction and the draw on liquidity, because that will determine which fair value gaps are still strong as well. Then the two fair value gaps is where I'm going to need the chart to explain it to you. So let's dive into the chart. So let's start off with the point relativity theory. Now the relativity theory states again that every time frame needs to be in context of the time frame above it, meaning that the 1 minute needs to be in context with 5 minute, 5 minute in context with the 50 minute, etc., etc. So the monthly time frame is the strongest time frame simply because it's the highest time frame. After that, the weekly is the strongest time frame, meaning that the weekly fair value gaps should be in context of the monthly. So simply because if a fair value gap is on the monthly, that is going to be the strongest magnet and the strongest rocket compared to all the lower time frames, the time frames below the monthly. So if we look at the weekly fair value gap right there, every fair value gap that is below this weekly fair value gap is going to be weaker than the actual weekly fair value gap. Simply because the weekly fair value gap is the strongest right there because it's the highest time frame. So if we go into the 4 hour right there, then on the 4 hour, we see the weekly fair value gap again. And we also see, for example, this 4 hour fair value gap. And that 4 hour fair value gap fails to deliver lower, fails to again create new bearish prices. Why is that? Well, simply because price wanted to trade into the weekly fair value gap because it's on the higher time frame. It's on the time frame above the 4 hour. So this 4 hour fair value gap sitting right there was not in context of the weekly fair value gap. So is that something you would want to trade off of? Well, in certain scenarios, it can play out like we talked about the breakaway gap, right? But if it's not a breakaway gap, then that right there is just simply said a lower probability fair value gap, where the higher probability fair value gap is the weekly fair value gap sitting right there. And the same goes, for example, for a fair value gap right there on the 4 hour. If there was a 5 minute fair value gap below that 4 hour fair value gap, then the 5 minute fair value gap is just simply lower probability because it's not in context of the 4 hour. And within context, we can understand that once this weekly fair value gap has been traded back into, has been mitigated, now it turns into a mitigated gap, and we continue lower off of that, this 4 hour fair value gap in comparison to this 4 hour fair value gap is now indeed in context of that weekly fair value gap. Because right now we have traded into the weekly fair value gap, so there's no reason after that 4 hour fair value gap right there to come back above that high because, again, very simply said, there is no other fair value gap on the higher time frame above this level right there, above this 4 hour fair value gap. So all the time frames are now in context of the 4 hour. So that right there is an extremely high probability fair value gap because every time frame is in context. So that is the first bullet point that we need to understand. That is the relativity theory. Now, the second one is that if we go back into the weekly time frame, then if we zoom out again, then on the same weekly example right there, we have this weekly fair value gap. Now that weekly fair value gap can now target this swing low sitting right there, which at that moment in time is of course also a previous week low. So that is the draw on liquidity. That leads me to the second bullet point again. That is the bias, where from that fair value gap towards that draw on liquidity, that first draw on liquidity, that is where on the lower time frame, so on the 4 hour, on the time frames below the weekly, very simply said, is where the strongest fair value gaps are being created. And where, again, in the exact same example, if everything is in context, so we have the relativity theory, checks off, perfect. Then we have the bias, also checks off. So we have the direction, we have the draw on liquidity as well. After that, we have two fair value gaps. So the two fair value gaps bullet point. And what I mean by that is we see the first fair value gap being created right there. There's the first fair value gap. After we retrace back into the first fair value gap and we leave behind another fair value gap, this fair value gap right there is extremely high probability to trade off of, where every bullet point checks off the relativity theory, the bias, the direction draw on liquidity, and the two fair value gaps. Then the two fair value gaps is where it's even stronger. That's the strongest, the highest probability fair value gap sitting right there. Which of course, after we have that manipulation gap, after we disrespect bullish fair value gaps, the bearish fair value gaps being created off of that are also extremely high probability. Now there's one thing that I need you to understand, that the size of a certain fair value gap does not matter. As in, if the fair value gap is bigger, it does not mean it is a stronger fair value gap. If the fair value gap is smaller, it also does not mean it's a weaker fair value gap. Now, the way I use fair value gaps is that if it's such a small fair value gap where I need to zoom into the chart and I need to go all the way like this to actually see the fair value gap, I don't count it as a fair value gap. Again, leads me to the story where not every broker is the same. They're not all universally agreeing on a fair value gap. And when they are universally agreeing on a fair value gap, that is when we can confidently say, all right, that actually is a fair value gap. So if it's very small, it might just be only a fair value gap on that particular broker. Now, the bigger a fair value gap, I would argue the more manipulation there also is. Because right there, we are seeing an insanely large momentum fair value gap going higher. It's a big fair value gap, which just simply leads to an overall reversal. So imagine how many people are getting trapped right there to then do the exact opposite. And we're using their liquidity. Then from section 4, we are moving on to section 5 already. And in section 5, we need to understand the fair value gap is, the way I see it again, is the superior PD ray. And the reason why I state it is indeed the superior PD ray is because of the other PD rays. Now, in order for us to have other valid PD rays, we always need a fair value gap. So without a fair value gap, like stated in the second bullet point right there, nothing is valid. An order block is not valid without a fair value gap. A breaker, a mitigation block, they are all invalid if they don't actually have fair value gaps supporting the ID. Which is all things we are going to go over in the next videos as well. So this is fair value gaps. As in, fair value gaps is the superior PD rate. They lead to every single step of your trading plan. They lead to every single concept that you can imagine. They are all told by fair value gaps. And in the next video, we are of course going to dive into this deeper as well. Now, just a quick heads up that in the new website, Arjo.io, we've also incorporated a 3-month plan. There was a lot of requests to actually do this, so we made it happen, of course. Which also leads me to say that we have a very interesting spring enrollment coming up, which will start the 1st of March. The full details will be announced very soon. It will not be your typical enrollment, where it's just 1 month. No, it's going to be a full spring enrollment. Very excited for that. And if you do want more information on that, of course, you can already reach out to info@arjo.io, where we will go over any questions that you might have. All right, perfect.